Welcome back to the Property Trio, the podcast for the sophisticated property buyer. I'm Dave, and as always, I'm joined by Kate and Mike. Good morning, guys.
Good morning.
G'day.
Today, we're diving into a topic that sits behind every mortgage approval, every cycle of credit expansion, and every period of sudden market cooling, or at least a large chunk of them, APRA. The Prudential Regulator has announced a new cap on high debt-to-income lending, something Australia has talked about for years, but not implemented until now. This matters for investors, for home buyers, and for the structure of the market over the coming decade. We're going through APRA's history of intervention in Australia's lending market in today's episode, how these new changes will impact you. We're also going to look at Australia's arrears profile, make some comparisons to other countries and their lending regimes, and then provide the detail behind the new settings. So let's get into it. All right.
Big one, Dave. Big
Yeah.
announcement
Huge.
from APRA, and the chair sat down with, I think, four corners, and interesting to hear his comments when they were sort of saying, is this targeted to homeowners or investors? And you say, well, it's not targeted to either, but it just happens to be that investors are probably the ones that are going to hit these concerns more than home buyers. But Dave, what is APRA?
Yeah, so look, Mike, thanks for asking me that question. APRA was created to keep the financial system stable and prevent credit quality from slipping when the market gets overheated. So essentially, they supervise the banks, the insurers as well, and also the super funds, which are getting a fair run of needing a bit more supervision lately. Most importantly for our listeners, they supervise the mortgage market because mortgages dominate bank balance sheets in this country, and they are where Australian consumers hold their greatest risk, financial risk. So Australia has one of the highest mortgage debt to income levels in the developed world. So that means relative to our incomes, our debts are very high compared to the rest of the world. So we're going to unpack some of that, some of the reasons why that is today. We're also one of the highest variable rate mortgage markets in the world. So that means with every rate rise, borrowers are impacted far more quickly because a lot of countries, and US in particular, most lenders have fixed rates. So the Australian mortgage market is quite unique. We're quite inventive with our products. And so APRA steps in for some of these to cover off some of these risks within our marketplace, which we'll unpack in today's episode. So, I'll hand the reins over to you, Mike, because you came up with this episode, and it's a really good topic. What did you want to add to that?
Yeah, look, I think the reasons why you just shared is why APRA is central to the story. I mean, that high proportion of variable interest rates means that any changes are felt within the economy fairly quickly. But even then, we're sort of limited to mortgage holders, right? So that's why I suppose people sort of talk about it as a bit of a blunt instrument. But when the RBA moves, the households will feel it in weeks rather than years, as distinct from the US. And APRA's job is to make sure that the borrowers banks are approving can withstand those shocks. They have a mandate to consider efficiency and competition, but the foundation is stability. So when lending standards drift or credit grows too fast, that's when we will see APRA, what is the opposite of keeping their powder dry? Wetting their powder. I've never had an answer to that one.
Well, they'll be shooting the bullets.
Well, for buyers, this matters because APRA indirectly caps borrowing capacity, even though it's not setting prices. So when you see the market suddenly cool without a change in rates, you can almost always trace that back to a tightening within APRA settings or serviceability rules that are set outside of the banks.
So, Dave, I want to ask you the question. Arrears are still really quite low, despite the large debt levels that you mentioned in the intro. And we've also had some really fast interest rate rises, and the media commentators were basically saying we're going to see massive mortgage arrears, but it hasn't really eventuated. Can you unpack that for us?
Yeah, I think it's because we're one of the few countries in the world that has offset accounts. So people have really big buffers and it's just not accounted for. Because when we're comparing to other countries, we're just comparing debt to income. We're not comparing the fact that our offsets reduced our interest. And we have an incentive, therefore, to keep more money in savings, where other countries have an incentive to put it into their loans because they're not reducing interest by sitting it in a savings account. So I think that has a huge impact. That is pretty immeasurable, but it has a huge impact. A lot of countries don't have redraw. So there's a buffer there that I'm not sure if that's measured. I think it might be, but how much access people have to redraw. So I think that's another reason. I think another factor is we have so much lender choice. So we have a lot more lender choice than lots of countries. And then I think we have a really strong mortgage broking industry, potentially now the strongest in the world. So there's this whole army of people who are out there to try and help people not get into trouble when it comes to their finances. So I actually think those four reasons are why we have really low arrears, despite potentially, well, the fact we have a high income to debt ratio. Yeah, so I think those four reasons are why we actually have low arrears and, not too many issues in our mortgage market despite the high income to debt ratio.
Yeah, and the RBA has pointed out that even after those rapid rate rises, arrears in Australia are still comparable with the United States, despite the US having 30-year fixed mortgages. And that's really quite extraordinary. As we've talked about on the show, it's the most rapid rate rise that we've seen in the history of the RBA. The RBA puts that strength down to strong employment and stricter lending standards, which is an important one, and that's where APRA really comes in. Australia adopted tighter serviceability tests well before most countries in and around the pandemic. We also didn't have the same wave of subprime lending seen overseas before the GFC, and that's a structural difference that we have in Australia compared to the US.
So basically, the RBA put it down to strong employment, which is patting themselves on the back.
Yep.
And stricter lending standards, which is patting their mates at APRA on the back.
Yeah.
Well, aside from the RBA, we've also got the behavioural element. So Australians pay ahead. If they get a tax refund or a bonus, it often goes straight onto the mortgage. And that habit has quietly protected a lot of people too.
Yeah, that's a very diligent sort of thing to observe about the Australian consumer, and something that I think we can be proud of. But Dave,
but actually, do you know why do we do that? Because our loans are mostly variable, and because we have redraw.
Yep.
Okay,
yeah, we
so
can park it there.
We can park it there and we can pull it back out.
Yeah.
So I think it comes back to the flexibility of our products and the choice we have, and then this army of mortgage advisors who are able to help us if we need to be helped, because we have different tiers of lending, of lenders. Yeah.
So, Dave, APRA is something that you can not necessarily think about for years and years at a time. However, since APRA was minted, for want of a better term, there's been a number of rather big interventions that they've done in the Australian property market, or let's just say the mortgage market. Can you unpack some of those for us?
Yeah, so if we go through some of the main episodes, they can explain exactly another reason why our arrears profile looks like it does. So there was the initial, when the market was flying along, 2013-14, there was the first intervention. Investor lending in particular was accelerating at 10% or above a year, and certainly some areas of the marketplace was well above that. So what they were starting to do was then cramp owner occupiers and first home buyers out of the market because investors were just buying. Historically, we've sort of had that 2/3 home buyers, 1/3 investors in the market, and they were starting to creep up. They actually got as high as 45% was all loans to investors. So APRA effectively told the banks to keep investor credit growth under 10% per annum or face supervisory consequences. That forced a lot of the banks to cool investor appetite and to tighten serviceability assessment. They also increased interest rates for investor loans then. So that's when we went away from owner occupier and investor loans being the same rates. And so investor loans became more costly as well at that point in time.
Mm. So it was the moment that APRA signalled that it was willing to use those macro-prudential tools, and it really reset the tone. And just by sort of way of background, I mean, APRA is not really that old as an institution. It was formed on the 1st of July 1998 after a Wallace inquiry into the financial system integrity, which was launched in 1996. And of course, APRA sort of was born out of one of the recommendations of that. In 2017, the interest-only crackdown obviously arrived with a big bang. We'll all remember that one fairly well. And APRA basically told the banks to limit interest-only credit to 30% of new lending and to pull back sharply on those high loan-to-value interest-only loans. And that hit leveraged investors hardest. And another way of putting that is the higher risk people. And that's what they're trying to avoid, is those high-risk loans. So particularly in Sydney and Melbourne, where valuations had run and really, really galloped ahead of incomes.
Yeah, you can see the evidence of that intervention in the price correction that followed. I remember those days. It wasn't caused by a downturn in employment, it was caused by credit rationing at that margin.
Yeah, and then we've had the most recent change in 2021 when APRA increased the serviceability buffer, which a lot of people, our listeners, certainly would be aware of, where the buffer above the rate you're about to pay on your new mortgage, you're assessed at being able to repay at 3% above your interest rate, not 2.5% above your interest rate, as had been the case for a long period of time. Now, let's just remind our listeners that APRA only governs banks, and so non-banks don't have to meet these stringent requirements. And that's why there is, a two-tier market, and why there can be other second-tier lenders, let's say non-bank lenders, where you can borrow more. So that single decision to increase the buffer up to 3% cut people's borrowing capacity by many tens of thousands for many people. Obviously, depending on your total income, the higher income, the more it reduces your borrowing capacity. So it can even be into 100,000 or more for some people. And they've kept the buffer at 3% even after rates have surged because they're worried about household leverage and job market momentum, even though there'd been quite a push for that to drop back down to 2.5 as rates started to come down in this last easing period.
Bit of a push from this show and all, Dave.
That's right. So
that's just me wanting, APRA to do what I want.
Exactly.
And if APRA did what everyone wanted, it wouldn't be APRA.
That's right.
Exactly. You wouldn't need a prudential regulator.
Exactly. Yeah, we would just ban all fund police and we'd all be getting 105% loans like the good old days. And I'd have a $100 million portfolio by February. Dave, APRA obviously wants to stop that from happening. But the recent news from APRA, we haven't heard from APRA for quite some time, but the new DTI cap. Firstly, what is a DTI and why is it important?
Yeah, so from February 2026, this is the new rule. Banks will be allowed to write no more than 20% of new loans with a DTI, which is a debt to income ratio of 6 or above. So I'll just put that simply. If your income's $100,000, Well, they don't want any more than 20% of the population or 20% of their loans borrowing more than 6 times 100,000, which is 600,000. Okay, so they consider if you borrow more than 6 times your income, then you're at a higher risk of being able to meet your repayments. So that's the debt to income ratio of 6 and above. So if you're earning 250,000 combined income, that's 1.5 million. If your combined income was 400,000, that's 2.4 million. If it's 80,000, that's 480,000, so on and so forth. So the limit applies separately to owner occupiers and investors. It's a genuine hard cap, not a benchmark. But as you might talk about, Mike and Kate, the lenders are not up even really close to 20% of their borrowers borrowing more than 6 times their income. But that's why it's a hard cap, and it's sort of putting a shot across the bow of banks and lenders or banks to pay more attention in this space.
And the chair in an interview was not wanting to name names, but he did say that there were some banks that were approaching that limit. That was kind of a bit confusing to me, Kate, because the old sort of conventional wisdom is that you get somewhere between 4 to 6, but the banks have kind of been imposing their own rules. I suppose they want to kind of preemptively think what APRA's trying to achieve, and no real bank wants to raise the ire of APRA, right? That was sort of a bit of a surprise to sort of say we've got this hard limit, because in my experience, banks weren't really lending to 6-time income anyway. I mean, brokers would often say, oh, look, depends on the bank, but you get to sort of 4 to 6. So it seems like the banks are already kind of operating with APRA in the back of their mind, because no bank really wants to raise the ire of APRA and be singled out, right?
Yeah, I think combine that with the fact that no bank wants arrears to have to deal with. Aside from the risk to their balance sheet, it's a pressure on their team as well. So our Australian banking numbers of arrears, I always think is reasonably encouraging. We go through it in our market updates all the time, and distressed sales. It's surprisingly low considering some of the headlines that we get on a regular basis. I think that responsible lending is a huge thing. And if you just look at the percentage of loans that are facilitated by mortgage brokers, and we all know exactly what kind of pressure sits on brokers with respect to responsible lending, I'm not surprised that it's not really an issue. I think that APRA doesn't necessarily have to monitor that too hard, because the lenders do toe the line.
Yeah, and I suppose if APRA was disbanded, you're not gonna go to your local bank and they go, how much you earn? 100 grand. All right, we'll give you $2 million. Because they're the ones carrying the risk. Like APRA doesn't necessarily carry the risk of the loan. So this is a bit of an unusual step. They're basically saying that they want to activate it well before the proportion of high debt to income loans becomes concerning in their view. So they're on the front foot, and this is really a prevention rather than a cure. One caveat is that they've said importantly that bridging loans and loans for new housing are exempt. That doesn't mean now is the time to go out and build a new home and get 8 times your income as a loan. But they're wanting to sort of reference the point that they don't want to discourage construction. So they're really wanting people to lean towards that rather than, speculative buying of existing stock. And that's something that we typically see with all government intervention is in and around housing. There's often an incentive for new builds, because the reality is we're about 30% shy of that target, and we're building at the same rate of approximately a decade ago, but we've got an extra 3 million residences. So the building industry is on life support at the moment.
Yeah, exactly. It's people don't account for how population's always increasing when they're looking at the number of new builds or how many sales we've had on average over the last 5 years. It should be going up every single year relative to population growth. So look, it's actually more than 20%, isn't it? you know, when you factor in bridging loans are only a short-term loan, but when you factor in all new housing, so maybe we're looking at 23% of all loans, you know, need to be under. Because I can just imagine the executives, you know, like they've got this rule, and then they've go, okay, we've got to figure out. We're already measuring this, but now we've got to create new systems to measure how every time new loans come in for new properties, and keep that subset of properties outside of, because we can lend to them above the 6 times, and then they'll probably go, you know, the time and effort that'll go into just being able to get that information accurately inside of an organisation. They might just say, look, it's not worth the effort. We'll just measure it across all loans. But we can be more flexible when people are buying new property. So, look, on current data, this cap is not binding. So only about 4% of owner-occupier loans and about 10% of investor loans fall above 6 times income at the moment. For our listeners really paying attention there, you'll notice that it's more than double the investors who have borrowing. It's more than 6 times their income. And that's because they'll tend to have more equity. So there's a bit more willingness for them to take extra risk. It's also because most serviceability calculators will factor in your tax deductible debt being cheaper, and therefore you're actually able to borrow more. So that's why they tend to be able to borrow more.
I'll start that again. Not everyone is as sensible as that. For some people, they're just told to maximise their debt to maximise their negative gearing benefit. And a lot of people fly blind and just think more debt equals good outcome. And you've also got your investors who are really driven and push it to the absolute limit. You know, they've got a goal and have X number of properties by, you know, X year, and they just want to go really hard and they borrow to their max.
Yeah, exactly. So yeah, a lot of people won't have even thought about what is the multiple of my income to my debt until they listen to this episode. It's a good point.
It is.
So make sure you share this episode with all your friends and family. So look, some banks will tighten their internal credit policies before the cap technically binds in February. And this might show up in how they treat overtime, bonuses, secondary incomes, and rental shading. Look, what they will, and self-employeds as well. They'll just, each time someone's applying for a loan that's more than 6 times their total income, credit assessors are going to just look at it a bit more tightly or closely, knowing from experience what they do. And each credit assessor, you know, is just a human being. And this human being has been told, oh, we have to be careful in this space. What generally happens is an overreaction. So that every credit assessor, every single time that a loan comes up that's more than 6 times income, they're going to look for reasons why it shouldn't be approved.
Interesting. Now, Dave, this new DTI cap, it won't cool the entire market. It'll just quieten down the riskiest end of it. Would you agree with that?
Yeah, I think so. I think it'll have a limited impact. I think there'll be an overreaction to begin with from credit assessors, and then, you know, their managers, if they're getting feedback from brokers or their internal bank sales staff, you know, here's this common sense, here's that common sense, and then internally at the bank, there's all these conversations and debates going on, and it's clogging up the speed of loan approvals. That's when you'll start to have feedback to more common sense. Like, that's sort of the internal machinations that happen within a big organisation when these things occur.
Yeah.
When I first heard it, I thought, oh no, APRA's intervening. This is going to be massive. Like the snow globe of Australian property market has just gotten a big shake. But then, like, looking into the detail, I kind of thought this is a bit of a non-event. I spoke to a broker and I said, look, what's happening? And they said, look, I'm getting a lot of calls. And the answer is, the question is, will this affect me? And 99% of them, the answer is no. However, like a lot of things that are announced in the property market, there's a lot of interest and a lot of thoughts and perhaps a lot of misunderstanding about it. And that was the reason why I wanted to sort of cast a little light on it. When APRA's chair, John Lonsdale, was interviewed, he described it as a targeted move to ensure the credit mix does not become imbalanced. And interestingly, he said that this is something that's consistent with global practice. For example, New Zealand, Ireland, the UK, and many others have been using income-based caps from a legislative point of view for quite some time. So, Dave, this is your chance to be speaker one for the negative. I want to know, like, who is affected, who can avoid this, and what impact do both you and Kate think that this will actually have, even though I've sort of said, maybe not much?
Yeah, look, I think it's possibly not that much, but I do think, as I said before, some credit assessors will overreact as individuals, and they'll put on their own cap as an individual and just look more tightly. And as soon as they see something's more than 6 times, they'll be looking for reasons to reduce the borrowing. And I think that's the human reaction that'll happen inside some lenders. But in terms of the macro picture, and that'll probably shake out over a few months. And if in terms of the macro picture, if that lender is allowed to go up to 20%, and they're currently sitting at, you just said, well, we had the numbers 10% investors, 4% owner occupiers, I think. So that's 14%. So there's a fair bit of room to move. So I think, as you just said, it probably in the big scheme of things won't have a long-lasting effect. But I think there could be short-term overreactions in some lenders and with some credit assessors, which could cause headaches to some borrowers and some brokers on their individual loans, where they have to, even though the serviceability calculator is positive, but it's 6.5 times the loan, 6.5 times their income. A credit assessor might find reasons to try and drag them down to 6 or 5 just under 6.
Yeah, it's interesting. I mean, I've sat through a few cycles, both as a mortgage broker and buyer's agent, when APRA have got a bit tighter and introduced macroprudential levers to control things. I think that everyone's very mindful of what happened during 2016 or 2015 to 2019. It wasn't just a credit squeeze. They completely strangled the market, and our markets all responded negatively to that. And that was in tandem with some other things that were really tricky for us to navigate, including the Banking Royal Commission. And we also had Bill Shorten suggesting that he'd scrap negative gearing on existing properties. And it was a tough time. So I think that everyone remembers that, that we're still haunted by that. And the other thing that I'm very mindful of is, if we have anything that slows down investor appetite, whether we have talk about an increase in interest rates or anything else, the market might normalise itself a little bit anyway. We've had a lot of global uncertainty, and we've had plenty of rhetoric about the stock market being at record highs and in danger of falling. And what we see when you get those two things is people turning to bricks and mortar. And we've maintained, I agree with Dave, I think 2026 is going to be a pretty busy year. So I don't know that we're going to see investor lending slow down, but if and when it does, that will be a natural break anyway.
The interplay with APRA and the RBA is an interesting one to observe, because this is a move that kind of reduces systemic risk. If we see an increase in unemployment for whatever reason, then this kind of de-risks those problematic kind of lending. So whilst APRA and the RBA don't necessarily work together per se. They don't sit under each other. They've got their own statutory mandate and government structure. They do both sit on a coordinating body called the Council of Financial Regulators. So there is actually a formal memorandum of understanding between RBA and APRA. So that sort of sets out how they coordinate on issues of systemic and financial system stability. So obviously that is something that I think we need to understand happens behind the scenes. APRA has a job for de-risking the loan markets. Obviously it's, you know, insurance and super, but the mortgage market is the one that I think APRA have certainly got their eye on, because we're seeing an increase in house prices whilst they were sort of intending to cut rates, and they don't want that to gallop away too much. The latest inflation print probably means that they can rest for a little bit of a minute, but obviously that is part of the mix. But Dave, when it comes to strategy, how should we consider this APRA change for those of us that are perhaps in accumulation mode or wanting to build a portfolio, or they just know that there's going to be some acquisitions in the future?
Yeah, look, I think if you're looking to borrow aggressively, let's say, and build a portfolio rapidly, and you know you're going to be above that 6 times ratio, so, do the simple maths. What's your gross income? And are you borrowing more than 6 times your gross income or wanting to? Well, then you need to have a good chat with your strategic mortgage broker to ensure that, you're selecting the right lender. You're, you have, well, ultimately it's selecting the right lender that's right for you. Basically, I mean, that's ultimately what it boils down to, because they can still lend more than 6 times, but you just don't want to go through the process of going to a lender who is going to be stricter. And so I guess, if you're talking to your strategic mortgage broker, you'd want to keep them accountable to make sure that they know why they're selecting that lender. It's not just all about interest rate. It's that the strategic mortgage broker or the whoever you're working with, is actually cognizant of the fact that you're borrowing more than 6 times your income. Otherwise, you could end up wasting a lot of time by getting all the paperwork together, submitting a loan to the wrong lender who actually knocks you back because they're a bit stricter in this space. They're closer to their 20%. They're tougher on someone who's borrowing for a home than an investor, or vice versa. So it comes back to making sure you're selecting the right lender relative to your own situation.
So we're not going to see 20% price falls or borrowing capacities cut in half. Can we sleep tonight, Dave?
yeah, we can sleep tonight. We can, but if you are in that space of borrowing more than 6 times, just dot the I's and cross the T's. But look, in summary, every single lender can actually still lend more than they are currently to people borrowing more than 6 times. Like, if we put it really simply, they actually can increase. This limit is above where they're all at today. So they actually all can lend to more people than they are doing currently, borrowing 6 times or more. Yeah. So that's a different way to look at it.
It reinforces the importance of resilience. Investors who rely on organic rent increases, wage growth, and diversified income sources will adapt pretty easily, but those who rely on maximum leverage will run into limits.
Yeah, so I suppose, if we wanted to put a spoiler alert in the beginning, we would say that, well, the broader message is Australia is now aligned with international best practice. We do have high mortgage debt, high variable rate interest rate exposure, and tight housing supply, but we also have a regulator willing to step in early, and that's why arrears are rising only gradually, despite increasing pressure on borrowers.
Yeah, so look, APRA doesn't get much airtime probably for the general public, and they are one of the quiet forces that keeps the Australian mortgage and property market stable. Today, we looked at how their past interventions have shaped credit cycles, why arrears remain low, and what the new debt-to-income cap actually means and how investors can position themselves in a world of clearer leverage limits. So thanks for putting that episode together, Mike. That was a good one to unpack. But look, don't go anywhere just yet. Our gold nuggets are coming up next.
Now it's time for us to go mining for our gold nugget property tip of the day.
We've seen these cycles before, and a lot of people panic when credit tightens up. And I think it reinforces the importance of having a trusted, strategic mortgage broker who you can lean on for good advice and preparation for these events, because they tighten up, but they also loosen when things change. You've just got to be prepared to ride that storm.
I think at the end of the day, it shouldn't come down to what a serviceability calculator tells you can borrow when you're deciding what purchase price is right for you. It should come down to what suits your cash flow and what suits you from a buffer perspective. And so at the end of the day of settling on your next property, you want to make sure that the surplus cash flow you have month to month is at a comfort level that suits you, whatever that amount of savings is per month for you. And exactly the same in terms of your buffer. If you want to have 100,000 in the bank after you settle, or 300,000 or 50,000 or $1 million, whatever that buffer is, those two things should decide what your purchase price is. So you shouldn't be, once you've made that decision, then you want to find a lender who will lend you that money at a very good rate, and make sure you work with a strategic mortgage broker who is going to get your mortgage strategy right, so you're maximising your tax deductions and getting all the strategy right as well.
Yeah, that's two great gold nuggets, because as part of strategy, you kind of need to know the rules of the game that you're playing with. But for me, I just kind of see this as an announcement, the announcement effect of APRA saying, we're still here, we're still watching. I mean, it's an interesting observation for me. The national spotlight was on APRA. Great opportunity to talk about reducing the serviceability buffer. They didn't, so I would expect that we're not going to see any of those changes happening now. The impact doesn't seem to be really, really big, but it's just kind of leaning into the fact that the RBA obviously is going to have some concerns about the housing market galloping away, especially if they do move to cut rates. And it's APRA sort of saying, we're keeping an eye on you guys. And they haven't said it explicitly, but it's investors to a big degree, I think, that they're going to be keeping an eye on, and just making sure that the whole system is safe. And we've talked about this before. People hit their head on a serviceability ceiling and they're like, okay, well, I'll go to another bank. Often it's a good opportunity to pause and reflect. There's a great Mark Twain quote that says, if you find yourself on the side of the majority, it's time to pause and reflect. If you have banks that don't want to give you money, it's probably a good opportunity to go, geez, is this a little bit risky? You shouldn't have to rely on APRA to save your backside. So just, I suppose, a word of warning to investors, but in many respects, it's business as usual.
Yeah, look, and you've probably hit on a really good point there, that it just provides more opportunity for banks to make it harder for investors to borrow, which supports, I guess, the government and a lot of these regulators and a lot of, I guess, citizens' desire to make it, still make it viable for particularly first home buyers to get into the market.
Yep.
So it's another little leverage point where they can make it harder for investors if they want to.
Yeah.
Fun police again.
Fun police indeed.
Well,
all right. Well, that
was a
great episode. Thanks for bringing that data and information in, Mike, and Kate, for all your wisdom imparted throughout the episode.
For my big contribution.
In amongst negotiating a purchase or two on text
struggling.
Messages, I think.
Have you done the deal? Everyone wants to know how close
deal's
are we?
done, yeah.
Oh, nice.
Yeah.
Fine-tuning the terms.
So when we have our
close.
live event, is there any way to have some sort of auction going concurrently so we can just
Yeah,
give
why
the
not?
listeners an insight into the
Wouldn't it
octopus
be
tentacles
cool?
you have going on all the time?
Yeah, imagine if we had like an online Zoom auction. I'll see what I can organise.
That would be awesome.
That would be fun.
All
It's
right.
that mad time of year right now. It's crazy season, and we're just seeing so many auctions pivoting and offers coming in prior and agents responding to other auctions that might be threatening their auction. And it's every year we get this, but it's really amplified this year because it's been a busy year across the board in Melbourne, and I am multitasking all the time.
And I actually think every year we say December is actually a great time to buy because a lot of buyers actually start to pull out of the market because they're getting ready for Christmas. And then there's a lot of desperate vendors who actually want to sell prior to Christmas and not have to have the risk of waiting until the property market opens again, which can be as late as February even.
Yeah, pretty much.
So yeah, it can be a really good time to nab a well-priced
good
property,
buy.
a good buy.
Yeah, you can buy a really good property, sometimes with little or definitely less competition.
Yeah.
And vendors get jittery. We've got this magic date, this line in the sand, Christmas Day. They all want to have a contract done and dusted before the big guy cruises down the chimney in his red suit. And it's the same every year. But yeah, like I said, it's a bit busier this year, and because of our auction volumes, we've got a few more on than normal currently. It's been a late spring, and we're just seeing so many transactions and twists and turns and mixed results too. Some strong results, some that are surprisingly lower. It's an exciting time, but it's exhausting.
So if you're looking to buy, keep going right through.
Don't give up now. Don't worry about Christmas
So there's
shopping.
no
Just
new
go out,
stock.
buy a bunch of gift cards and keep doing your Saturday inspections.
Yeah. All right, we better wrap up and see you all next week.
See you next week.
Bye.